Hi, welcome to the Commercial Insurance Channel. My name is Rick Faber, and I am the co-founder of Underwriters Resource. Welcome to today to the first part of a four-part series delving into financial underwriting. For those of you who are not that familiar with financial underwriting, over the course of my 40-year career, it's one of the things that really separates the real underwriters from the also-rans. So if you're really going to be a first-notch underwriter, you're going to have to know how to underwrite a company's financials. So welcome. Welcome back to Financial Underwriting, Part 1. In Part 1, we're really just going to focus on one question, and that question is, why should underwriters and agents focus on financial underwriting? But before I get started on the reasons why we should do it, I want to talk about two very bad reasons about why we should explain that we need to do it. And whenever I've heard these two reasons, it's kind of made me cringe over my career. And the first bad reason that I've heard is I need to complete my underwriting file. Now, this makes absolutely no sense. As an underwriter, you're going to ask the agent, or as the agent, you're going to ask the insured to jump through hoops, provide you additional information that you're only going to put in your file and not really use. It doesn't make a bit of sense. And the other reason that doesn't make any sense is I need to see if they can pay their premium. In a large segment of our industry, the premiums are all paid 100% up front. And even if we put it on installments, we are enabled to cancel the premium when only giving 10 days notice. So we're really only worried about that credit risk for 10 days of insurance. And when you figure out what the cost per day that premium is, it's really negligible, and it just really does not make any sense. Moving on to the first reason why we should evaluate financial strength. The first reason is to confirm the accuracy of the rating data. Let's be realistic. For the most part, many of these applications that agents complete and send on to underwriters, they basically are photocopies of last year's. And sometimes they don't even bother to check to see if the rating data that they have on the application is accurate, whether or not it's changed. If you want proof of that, I've seen so many times as an underwriter where we've had major additional premiums because of a premium audit, or on the other side of the coin, where we've returned a lot of premium because of a premium audit, because that rating information was not accurate. As an underwriter, we need to have accurate rating data to know that we are going to actually be collecting the appropriate amount of premium for a risk. A second reason why we should evaluate financials is to uncover additional rateable exposures. As you're looking through a financial statement, if you look through the revenue side of it, you may see where, in addition to manufacturing, they're also distributing products for others. Or if you're looking at the expense side, you might see some extra rent exposures that might indicate additional locations. Or reading through the notes, if it's particularly if it's a public corporation, you're looking at an annual statement, you might find that there's actually additional operations that we're not rating for. Or even you might even find that on the financial statements are listing a second potential named insured. So the second reason is to uncover additional rateable exposures, because we need to do that as underwriters and agents to make sure that the premium being charged for the risk is a fair premium and appropriate for the loss potential that they present. A third reason to evaluate financial strength is to understand and find out if the insured actually has the ability to afford all those risk controls. For example, if they have a sprinkler system, you have to periodically have that sprinkler system tested. You have to perform maintenance on it and things of that nature. Or if you have safety programs, they do take resources, and you do have to be able to afford it and be able to have money to continue those controls. A fourth reason is to evaluate the ability for the insured to see if they actually can cover or pay third-party deductibles. The way deductibles work in workers' comp and general liability and auto liability is that the insurance company is going to adjust and handle that claim just as if there was no deductible. The claimant makes a claim, the insurance company adjusts it, they pay it, and then they submit that bill to the insured for reimbursement, and then the insured actually pays them back. So if it's a substantial deductible, the insurance company and the underwriter, you want to make sure that that insured and that risk actually has a wherewithal to actually cover that deductible. It's bad, it's not good if at the end of a claim, the insured has to pay a $25,000 deductible or something, or whatever it is, and you find out they don't have the money to pay it. That's not good. The fifth, and what I feel is actually the most important reason to evaluate financial strength, is the fact of what financial strength tells us about the client. There's a very strong correlation between the quality of the risk and the quality of their financial strength. In that formula there, financial strength equals good management. When you think about it, when you think about a company that's performing well financially, they're in a good liquidity position, they manage their debt well, why are they so successful? They're successful because they manage their company well. Now, when you think about things like safety management and quality control, those are really, when you think about it, just a byproduct of good management. They're managing everything about the company well. And while they're doing that, they're managing safety, they're making sure that all the controls remain in place, they're making sure that their product and what they turn out or their services that they provide, that they're all done on a high quality basis. And I will tell you, over the course of my career, there's probably at least a 75% positive correlation between financial strength and good management. If I look at their financials and they're strong financially, I'm almost always correct in the fact that when I get that inspection back, they're glowing and they talk about how good the risk is. But I will also say on the reverse side of the coin, there's probably almost 100% correlation between poor financial strength and bad controls. Because when they go, they don't have the money to do things, and when they go out and they inspect that risk, nothing's good about it. So, from an underwriting perspective, if you're really underwriting for risk quality, which is going to generate a better underwriting profit, you really want to look at financial strength and make sure that that company is well managed.